Well guys, the stock market continues to be highly volatile and somewhat irrational in the way that equity prices have been trending green over the past week or so. But does this now mean that we're looking at a smooth sailing, or do we still have some rocky waters ahead? Let's find out. Hey, what's going on, savers and investors? I hope you all had a great weekend. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be speaking about how the stock market has opened as of April 20th and how the market is reacting to news coming out about the medical issue, the unemployment rates, as well as the Feds seemingly printing as much cash as they want, and how this is having an impact on the economy and the stock market, which really seems to not be following any trends whatsoever of the underlying value of these equities in question. As the market stands, the Dow is currently sitting at around 24,242 points, which is just insane considering that less than 1 month ago, the Dow had retreated down to 18,500 points at a total loss of roughly 37% across the board. And as of today's market price, the Dow has crept up nearly 6,000 points now at only an 18% loss since market highs in February, which is still major, don't get me wrong, but is a significant increase since late March. And this has many investors wondering whether or not this is justified or if the stock market is drunk at the wheel. In other markets and indexes, for the most part, everything was green over last week's trading period, and now early week trading today following last week's rally. We have the Nasdaq Composite Index up about 0.21%. The S&P 500 is down around 0.46%, and the Canadian TSX is up roughly 0.30%. So basically across the board over the past couple of weeks of trading, we've seen investors with higher levels of confidence in the markets, mostly attributable to a couple factors that we're going to be digging into. But how is the stock market reacting in relation to the underlying economies of both Canada and the United States? The stock market is currently surging while the underlying economy itself, though, is in distress and isn't showing any signs of improvement in the near future. In fact, it's doing worse than only a couple weeks back when the stock market was tanking. Unemployment levels in both Canada and the United States are continuing to rise, as we can see on these graphs. The unemployment rate in the United States has risen to 9% and is expected to reach 15%, while unemployment in Canada is currently sitting at 7.8% and is expected to rise to levels of 8.9%. In addition to this, there are some economists and financial analysts that are still predicting that one of the largest financial recessions in history may still be upon us. In parallel to the unemployment figures, medical issue numbers are still rapidly growing with no true concrete signs of slowing down. We can see daily levels in America still relatively constant, with the same thing in Canada. So without any concrete evidence on wide-scale business operations being back up and running in both Canada and the United States, it's quite shocking to see the stock market surging in the shadows of a hurting economy. I mean, honestly, think of how mind-blowing it is that right now stocks are surging while most businesses are temporarily shut down, and we're living through one of the worst periods in history for company earnings, growth, and expansion. And this is not because these companies want to be closed or limiting their business operations. This is literally because the government is mandating that these companies be shut down and are encouraging people to stay home and consume less, essentially. I was looking through my Amex statement recently, and all I've really spent money on in the past month or so is groceries, one book, a couple little things here and there, and gas about once per month. So there really isn't all that many places that you can spend money right now, and unless you're some compulsive shopper who's buying stuff online every single day, this is basically across the board. People have money to spend but aren't spending it because there's less opportunity to do so, and this is going to have a severe impact on company earnings, which we're going to be seeing firsthand as we've just entered earnings season, where companies are releasing their Q1 numbers. In fact, as you can see here, most companies have still yet to even release their earnings reports, meaning we're most likely in for a big surprise. So considering this lack of spending in the overall economy, the fact that the Nasdaq is now only down roughly 4.53% year to date, the S&P 500 is down roughly only 12.02% year to date, and the TSX is down only 15.7%. What is going on with equity prices surging, and is this justified? Well, given the fact that last week's move in equity and credit markets was exceptionally strong, I definitely think that we could still see somewhat of a pullback. Now, due to new information that we're going to be speaking about in the video, I don't think we're going to see a pullback as far as March lows anymore. However, I do still think that a small pullback could still be upon us. For this reason, it's critical that investors keep an eye out on small dips and capitalize on those opportunities in order to lower your cost basis on your positions. Again, I personally was not buying any stocks last week, and even the week before that, I wasn't really adding any positions to my portfolio. We'll see what the market has in store for us this week, and I may or may not be buying. Now, as we all know, stock prices reflect many different factors and inputs, but here's the thing: investor expectations of price fluctuations in asset values, along with current market news and earning reports, tend to drive short-term price fluctuations of equities more than anything else combined. In short, stocks that have medium to high investor expectations on earnings or other metrics such as growth, etc., can often do more poorly if the numbers do not reflect the investor expectations, versus a stock that has low expectations from the get-go. Even if poor or negative news comes out about that stock, oftentimes this negative news can be looked over and not really have an impact on the price fluctuation of that equity. Where I'm going with this is that most likely the current stock prices in the market, having surged over the past week, already has investor emotion of stimulus packages and potential solutions to the medical issue priced in to investors' short-term bullish outlook based on unfounded reason. I've been saying this for the past month or so, but this could very well lead to higher than normal price fluctuations in equity prices once Q1 earnings for the majority of companies, at least in the S&P 500, are released, which, let's be honest, are most likely going to be terrible. And I really don't think that this reality is priced into current market prices, considering the fact that over the past couple of weeks, the market has surged quite tremendously. Let's keep in mind that Goldman Sachs has still predicted a 34% decline in GDP for Q2 in the United States, and this is while unemployment numbers are soaring. I just feel like the market is still somewhat recovering too quickly. Now, yes, this is just a feeling and we'll see how this plays out, but from an actual recovery based on economic factors, the stock market is just not in correlation with the underlying economy and feels artificially propped up more than ever. Alright, so with everything we just covered, why do I think the stock market has been trending green over the past couple of weeks? Based on what's currently happening, I think the stock market is currently on a good news rally, in part due to the fact that most federal governments are pumping their economies with cash in forms of stimulus checks and checks to small businesses. During the month of March as well as April, most Canadians in need have already received their $2,000 monthly CERB checks, and in the United States, the second waves of stimulus checks have started being rolled out. But in all honesty, these are minimal amounts that really only cover basic living costs and either won't be used or shouldn't be used on general consumer spending. So although the Feds are injecting the markets with cash and bailing out high debt companies, this is potentially temporarily only propping up market valuations based on investor sentiment. With that said, Ray Dalio, the founder of the investment management company Bridgewater Associates, came out recently saying that basically the federal government will do practically anything in order to help the economy stay afloat, which means pumping the economy with more stimulus checks and bailing out companies that are in high levels of debt, even if they were mismanaged from the get-go. This is what he's saying is a solution to the problem of bringing back the economy and lowering unemployment levels back down to pre-recession levels. However, do keep in mind that pumping the economy with this much money in billions or even trillions of dollars does have the effect of bringing up inflation levels. Just take a look at this chart of the American Fed's balance sheet showcasing the amount of money being printed, which is happening at the same time as lowered interest rates. We can clearly see that during the period of 2020, at least year to date, during this whole situation, there has been a tremendous amount of money being printed and pumped back into the economy. From an inflation standpoint, if there's a higher level of cash that's being printed and then pumped into the economy, this lowers the value of the dollar, so all the money that's sitting in your bank account has a lower value or a lower purchasing power. So investors are always trying to look at the best way to store and grow their wealth, which if there's way more money being printed and pumped into the economy, this lowers the value of cash, meaning that other assets are going to be more attractive to investors. So basically, I think the market is recovering far too quickly, due in part to the Feds printing money and distributing stimulus packages, which will inevitably lead to inflation in asset prices because they can prove to store wealth better than cash, such as stocks or real estate. But this absolutely does not mean that the current equity prices in the stock market are justified. And this isn't to say that there might not be more dips once company earnings are released, but I do believe this may be one of the contributing factors to surging equities with the thought of inflation. Now, in addition to the Feds pumping the economy with cash, cash, which definitely has an impact on equity prices. There was one company called Gilead that basically came out saying that they were developing a drug that somehow showcased effectiveness in treating the medical issue, giving investors some hope that there could be a treatment solution that helps the country reopen faster than anticipated from widespread shutdowns that have plunged the economy into the recession. That said though, this is a typical good news scenario where a piece of information comes out that is somewhat positive and then the market reacts to this, but this isn't necessarily out of logic and rational outlook. Gilead has only started a round of tests as of right now that is inconclusive, and formal evidence of their drug working to treat the medical issue is only going to be released by the end of the month and as of next month. So this really brings no further confidence to me at least, and I think that the fact that the stock is surging is only based on speculation, and this has had somewhat of a buoy effect on the broader markets. Now for all my viewers, I want you to keep in mind that the market continuously going up can very well create a FOMO environment, which we spoke about in a recent video, especially if you're a new investor and you're seeing the market continuously going up over these past 2 weeks or so. You could definitely think that getting in right now while the markets are somewhat hot could be the right time to get in so that you don't miss out on the opportunity of future gains. And you know what, maybe the markets will continue to go up, but from my perspective right now, if you're getting in on the market and the current inflated prices, there's a higher risk than potential reward to investing right now. I already invested several large chunks of capital down in this period about 3 weeks ago, and now I'm waiting to see what happens, feeling pretty comfortable with cash reserves. Alright, so many viewers asked me to make an up-to-date market news video on what I currently think is happening and why the markets are surging. I hope you enjoyed the video. Let me know down in the comments what you think of this complicated matter, and if you enjoyed the video, make sure to smash the like button. It really helps the channel grow. If you want to learn more about stock market investing, then make sure to check out one of the 2 videos right here, and I hope to see you in the next video.